the minutes from February 10th.
I'll make a motion to approve.
Is there a second?
I'll second.
All in favor?
Aye.
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 Yes. Just for the record, if you could identify yourself, just so we know who is at the meeting.
Jim Hendrickson's here.
Rich Baskin is here.
Joe Kramer is here.
Frank Nash is
Eileen
obviously here.
Romeo.
Is that it? Perfect. Is there any public comment? If not, we'll move on to the approval of the pension applications. Jerry, are you with us?
Yes, I am. Can everybody hear me?
I
Yes.
believe we can.
Okay. We have two applications for this evening. The first one is Sandra Scarzo, a paraprofessional with the Board of Education. She's with the city 32 years, 8 months. Age 75, she has a regular pension benefit. She's elected option 3. Her monthly benefit is $1,470.98, annualized $17,651.76. The second person is Patricia Olson, also with the Board of Education. She's a special ed aide with the city 30 years, 3 months. She's 73. Hers is also a regular pension. She's elected the standard option. Her monthly benefit is $1,987.93, annualized to $23,855.64.
Are there any questions regarding these two pensions? If not, is there a motion to accept them, approve them?
I'll make a motion to accept.
A
I second.
All in
I
favor?
second. Aye.
Aye.
Aye. Passes unanimous. Thank you very much. Next,
You're
the
welcome.
actuarial. I'm sorry, Jerry, did you have anything else to say? Okay, we get Ed on here, right? I believe Ed is muted right now.
Sorry about that. That's the phrase of the year, huh? Hey, it's a pleasure to be here. My name is Ed Coble. I'm the Chief Executive Officer with Kavanaugh McDonald Consulting. With me tonight is Ben Mobley. He's a consulting actuary with our firm. We are both down here in beautiful Atlanta, Georgia, where it's 75 degrees today. Sorry. But it was a beautiful day. So hopefully you guys are getting nice weather up there in Connecticut. It's been a great year working with staff. I just want to kind of throw that out there. We appreciate all of the help of Chitsme and Jerry and Ray and Mr. Dakowitz for all of their work with us throughout the past almost year now that we've taken over the account. Couldn't have done all of this without their help. So I'll start. Ben and I are kind of going to go through the 4 valuations, the 4 pension valuations. There is no OPEB valuation as of 2020 because it's not the biennial year. But we'll kind of just want to talk first about the transition to Kavanaugh McDonald. We appreciate the pension board giving us the opportunity last May to provide a finalist interview and presentation and selected us. The contract was signed at the end of July, and we quickly went to work sending out transition letters to both the previous actuary and the city at the end of July. We worked with the board a little bit on the early retirement window calculations that were done in September. In reviewing those, the cost of those calculations and the implications on the city's plan from the prior actuary did all of the calculations, but we verified those and we're happy to report that they were all good to go. You'll see throughout the city's presentation the impact of of what those 44 early retirement window calculations did to the liabilities of the plan. The 2019 transition, we completed that around the middle of October. So we did a full replication of the previous actuary's 2019 valuation. So, and we'll report on that during this meeting as well. The GASB, Governmental Accounting Standards Board draft reports were sent out beginning October 30th, so soon thereafter. And that was a roll forward from the 2019 valuation results. So it was very important to get that transition completed. And then the funding, the actuarial valuation funding reports, we worked through the winter and were able to send those beginning February 3rd to staff. So again, the transition from the prior actuary went terrific as far as the pension plan's concerned. We typically, when we do a transition from a previous actuary, we like to get within what the actuarial standards of practice say was within a 2% threshold of matching the same liabilities that the prior actuary came up with. And we're happy to report that for the city and fire, we were within 1.2%. And for the police and food services group, we were within 1% of those liabilities from the 2019 valuation. You'll see the number of liability that we were off in the next slide, but just to give you an idea, we were very close and very happy to report. It helped that the actuaries use the same actuarial software. So I think that really made a big difference that we both use ProVal as part of determining those liabilities. So that really helped things out. As far as the OPEB plan was concerned, we had a lot harder time matching those liabilities for the Board of Education. And we took quite a while to finish that up because we went back and forth with staff. And then we actually got the Board of Education folks involved just to confirm some of the findings that we were seeing. But basically, we confirmed with staff that most of the Board of Education retirees are responsible for the full cost of coverage for themselves. So once they reach age 65, the retiree pays the majority or 100% of the cost. There are a few exceptions for school administration, for executive support, for nurses, but for the most part, they are responsible for the full cost of coverage. And the prior actuary had a significant amount of liability for over 65 coverage for retirees and dependents that we just could not match. So it was actually a savings to the OPEB plan of around $13 million, which was about 9% of the accrued liability in total. So we're going, when we do the 2020 valuation or 2021 valuation for OPEB, you're really going to see a difference in the liability for the Board of Education. Now, it's just the Board of Ed, so it's a small portion of the liabilities. The city, police, and fire folks, we matched, again, within actuarial standards of practice, actually pretty well there. Any questions as far as that's concerned?
Yeah, what's the definition of full cost of coverage? What are we covering? What are they covering?
They cover their entire cost of having retiree healthcare coverage from the city. Yeah.
Okay.
All right. Great question. Okay. So we'll jump right into the Governmental Accounting Standards Board since we did that first. As far as the valuation, again, it's a roll forward of the 2019 funding reports to June 30th of 2020. We typically do those pretty much right after June 30th hits once we get the final asset amounts as of June 30th. There was a reduction in the single equivalent interest rate. You'll see different acronyms for accounting versus funding. But basically the discount rate was dropped from 7.125 to 7%. We're now down to 6.875 for the 2020 vows. But the 2019 had the drop down to 7%. So the transition cost or savings, that the difference between the two actuaries as far as the liability, GASB wants you to immediately recognize those amounts in the pension or OPEB expense. So, where we typically see on the GASB side of deferring the certain liability or experience over a smaller period, for transitional costs, we want to immediately recognize those. So you'll see those numbers in the next slide. The annual money-weighted rate of return for fiscal year 2020 was about 2%. It varied from probably 1.6 up to 2.4. But for the most part, it averaged right around 2%. That's not bad, getting back to 2%. If you recall, back in late March of last year, where markets were, and what we were looking at potentially of -10, -15% returns, to get back to 2% by June 30th was not a bad result at all. So, and then glad to see that the city is making the full actuarially determined employer contributions for the fiscal year end 2020. We have a lot of clients where that's not the case, so we like to report it and give props for those plans that do make those full contributions to their pension plans. So those were made, and they've always been made to the pension plans. So just taking a look at the liabilities and the numbers that go into all of the annual reports for the city and all of its plans. Here's just a breakdown of the 5 plans there. The total pension liability is very similar to the accrued liability that you see on the funding side. The fiduciary net position is your market value of assets, or basically what do you have in the bank as of June 30th. On the funding side, we do a smoothing technique, so you'll see a little bit of a different number there. The net pension liability is the difference between those first 2 numbers. And you can see the majority of the plans are over 70%. The food is still a little bit lacking, but that's pretty volatile since it's a much smaller plan. But having a funded ratio or an accounting ratio over 75% is really good. The average plan is about 71%. Public sector plan is about 71% across the country. So good to see that those funded ratios and the plan to get those closer to 100%. The assumption changes there are basically the drop in the discount rate and what those costs were. These numbers are all in millions. And there's the transition change that I've referenced a couple times now of how far we were off on the prior actuary's number. So the city, we were coming up with a higher liability of about $3 million, but for police and fire, we were coming up with a little bit lower of liabilities than what the prior actuary came up with. So if you add the 4 pension plans, they really netted to almost zero. And there's the $13 million transition savings that we saw in the OPEB plan. The experience, 3 out of the 5 plans were gains. And then the two plans that were losses were very small losses. So good to see some experience. And these are the demographic or investment changes, demographic changes that happen throughout the year. So any questions on the GASB? Great. Okay, again, I'll touch base on the city's employees pension plan. Now we're getting into the valuation results, and then we'll hit on the other 3. Ben will take a couple of them, and I'll come back. But just the valuation key findings on as far as the investment return on the smooth actuarial value basis. We saw a return of about 4.6%, so a little bit higher than the 2% we were seeing on the market value. So, but still a little bit below our 7% assumption at that time. So we will see investment losses for the majority of these plans. We had 44 folks take the early retirement window. And then what since, even though it did occur after the valuation date, as far as our actuarial standards of practice, if we know about it and it is going to be a significant event that occurs, we value it as part of the valuation. So those 44 folks were run as of retirees, as retirees rather than active members. Even although they were active as of June 30th, we treated them as retirees. The unfunded liability for this plan increased by about $18 million. And again, you'll see those numbers more in detail. This is just a high level. And here's the breakdown of that $18 million, basically. About $8 million was due to the early retirement window. Again, very much in line with the numbers that you saw in October from the prior actuary. All that analysis that was done was showing about an $8 million increase to the liability. By putting those folks to retirement status, immediately, that increases your liability. The assumption change in the discount rate, that has about a $3.3 million increase to your liability. The transition there was $3.1 million. And then the investment experience, that 4.6% return, not getting the matching the 7%, has about a $4.9 million. So that's how you get the $18 million. Again, we'll show you the numbers in a couple slides. So for this plan, the funded ratio was decreased from 82.8 to 77.2%. And then what we're showing as the actually determined employer contribution is for fiscal year end 2022. So beginning July 1st of 2021 to the end of 2022 will be $6.8 million. And this is about a $1.2 million increase from the current fiscal year that we're in. That was about $5.6 million. Again, feel free to ask questions along the way, but we'll kind of dig into the weeds of those numbers and give you a little perspective of where those numbers come from. So here's a look at the last.
Ed,
Yeah, yeah.
You have a breakdown later on of what. So we have an increase of 1.2 million last year, and we have the breakdown of the 4 items that increase the unfunded liabilities.
Yeah.
You have a breakdown of what each of those contributed to the increase for the in the ADEC.
I don't, but we can certainly do that. But it's basically almost proportionate. You can do a proportionate of, if the 7.9 was the ERW of the $18 million, you can almost half.
Okay.
You can say
I
that
just wanted, okay, it's proportional. Like I'm
you
good.
can, yeah, you can basically
okay.
estimate that proportionately. Yeah.
All right, thank you.
Yeah, no problem. All right, so here's a look at the historical membership. You can see the big drop in the number of active members. That's the green bar on this slide. So now down to 300, just under 350 active members. Again, these are as of June 30th of 2020. And then we have a big tick up in the number of retirees of 724. Historical pay is now down to about just under $24 million to those 350 active members, and our retiree benefits have increased now, or paying benefits out of $17 million out of this plan to the retirees. And again, we're going to see this shift over the next few years as this plan is closed and more folks will be retiring from the plan. As far, yep.
Can I ask a question? So
Sure.
what the contribution is from the city and the amount that the employees who are active now, do you have a number for how much is going to be the drawdown from the pension plan? How much, how much will the pension plan have to pay out?
Yeah, so
These-
that's
out of the assets that we have.
yeah. So the assets we'll show you in a couple slides, but you're basically paying out $17 million to your retirees. That's expected. That's the amount as of June 30th of 2020 for the annual amount going forward. Now, of course, there's probably been some retirements since then. There's probably been some deaths of those retirees, but you can kind of estimate that benefit payments for the fiscal 2021 fiscal year will be around 17 to 18 million dollars.
And the city
And
will contribute roughly 7.
Yeah, and employees are contributing. Employees contributed about
Around
a little over $1 million last year. So we'll see that number keep creeping down as the number of actives go down. But
So this had been running around 14 to 15 million in the payouts, and then it jumped to 17. Was that the 44, the early retirements?
that's right. That's exactly right.
So we would expect that to stick around 17 or 18 for the next several years.
Not necessarily. No, we anticipate seeing that jump up. You've got an active population that is averages 55 with 18 years of service. So you're going to see a good number of retirements from this group in the next few years. You've got 52 active members who are over 65 as of June 30th of 2020.
So the runoff here right now is around 10 million, I think, from what you said, right? It's the city, the payouts less the city contributions was about a -10 this year, 2020.
Yeah.
And that will, do you have would you have is your analysis at some point in subsequent slides project what that will look like in the next 5 years?
I don't, but we can certainly look at that, look at the breakdown of what we anticipate seeing for contributions. As a closed plan, you want to build up your asset pool to have enough money for that last active that's out there and contribute the money for when they're retiree. But we don't want to have all this money left over. So you play this game, and that's why this plan has been it closed its amortization. It's doing all it can to get to that point where we're going to be kind of valuing the liabilities on a pretty much all retiree basis within the next 10 to 15 years.
Okay.
So, but yeah, we can certainly look at a projection, 5 years, 10 years of the cash flow for this plan to make sure it's going according to schedule.
Yeah, I'd be interested now to see what this looks like, 5-10 years out.
Yeah, no, great point.
The assets right now are roughly 200 million,
Mhm.
right, in this plan.
Yep.
And we're gonna have a negative draw of 10 million.
So you've got a -2% cash flow. That's not bad. Most plans, that's not a bad negative cash flow procedure for a very mature plan.
And when would you guess, based on what you've seen, when would you guess that 2% draw would increase to, say, 5%, where we're kind of basically treading water with returns, maybe?
It's see.
Because we're still at a stage where the asset appreciation is keeping ahead of the draw.
Right.
Yeah.
Yeah. I mean, you're going to see probably within the next 10 years, you probably will have close to a $14-15 million negative cash flow. But if you get 6.5% return on the market value, that's going to beat that negative cash flow. So that's what we just want to make sure occurs going forward. If we start seeing negative cash flows approach the -4-5 range, we'll let you know. I mean, or if we see that occurring in the next few years. But again, we're okay if it happens 20 years from now, because that's okay, because we do want to start then drawing down that asset pool at some point when all of these folks are retirees.
Okay.
All right, great questions. So here's a look at the liabilities as of 2020 for all of the members in the plan, about $268 million. in liabilities. So 178, most of that 2/3 is for retirees, not surprising. 30% for actives and the rest for the small amount of deferred vesteds who are entitled to retirement benefits in the future. So again, here's the look at the assets, historical. We'll kind of build on this as we go. We only had 5 years of historical assets from the prior actuaries reports. I like to show 10 years here. You get a better picture of a 10-year number, especially if you have a really significant event like we saw in 2008 and 2009. It really, showed how volatile the markets can be and why exactly we use an actuarial smooth value methodology here. So we'll keep building on to this graph over the next 5 years. So when we compare that liability to the actuarial value of assets, we come up with our unfunded accrued liability there. And you can see the increase of about $18 million from last year's $42.7 million up to the $61 million there, $18.3 million increase. Here's a look at the historical funded ratio for this plan. So we had been hovering for the past 4 years prior, right around that 83% ratio. And then the drop here due to all of that experience, most of it, the ERW that occurred.
But
And
we're,
then-
given the market's performance, we're probably back in the 82, 83 range again, I would think, right? If you do this today.
I hate to forecast because we still
Yeah.
have 3 more months and we know what happened last year when
Yeah.
but yeah, we're really excited as actuaries. We're really excited when plans experience good investment years. I know it's not our cup of tea in the investment sides, but we get to report good numbers to y'all. So
Yeah.
we love it when we're seeing double-digit positive returns for sure. So hopefully, fingers crossed, it continues for the next 3 months. So this slide is really important to review, and it's part of the valuation report. But this is kind of we call it the report card of what we saw actually occur in the year versus what we expected. So again, we have assumptions for all of these components that go into the liability calculations. So the investment return assumption is 7%. Well, the plan experienced 4.6%. So there's a loss there expected. $4.9 million. There's an anticipation of folks' salaries increasing a certain amount each year. Well, when those don't, you either get a gain or a loss. If they go above what we expected, you get a loss. If they're slightly below, which they are here, you get a slight gain in your liability. Retirement, same thing, disabilities and mortality. If there's a gain in mortality, that means more folks died than what we and the mortality tables actually predicted. So, again, these are real small, obviously, in comparison to the other things that occurred in the plan this year. But if you look at these 5 components here, they almost wash out to about 0. So very small demographic experience. That means the assumptions that you currently are using are working pretty well with the experience of the plan. Okay, so we're seeing very small amounts of variance in service retirements and in mortality and withdrawal. Those are real small amounts when you look at the grand scheme of things of the total liability.
On the mortality, does any of this reflect COVID?
We're seeing a little bit of impact on COVID. It will probably see more in the 2021 valuation. Connecticut was part of that New York group where it was a little bit, but we actually saw a gain for this year in mortality. So that means, well, no, I'm sorry, there was a gain.
Yeah.
So there were a little bit more deaths. So you saw that. You probably see another gain next year, and then it might go the other way or it might go the other way this coming year because there were more deaths. We're not really making adjustments to our mortality tables due to this experience. It's just going to kind of let it flow out into the gain or loss.
Okay.
Okay. And then here's your other experience, and that we combine that with the transitional piece of the $3.1 million loss. So actually the other, which is kind of just what else happened to the plan, was a gain, but overall that was a loss. And then the assumption change in the discount rate from 7 to 6.875, and then the ERW is the big line down here at the bottom. So again, the ERW will be gone next year. We'll still have an assumption change because we're still working our way down to the 6.5% discount rate. So we'll continue to see about a $3 million loss in liability due to that drop. But that's the way to really go here in getting that discount rate back down to 6.5. So when the board made that decision to do that, that was a very good decision to kind of phase into that assumption. And then last few slides here on the city plan is just the breakdown of the actually determined employer contribution. We call it ADEC. You'll kind of hear us say that as part of our presentations. But basically, this is what we anticipate the city's contribution to this plan being. We break it down into normal cost, and then some ancillary pieces, interest, and then the big piece is how we're paying for that unfunded accrued liability, which you can treat similar to your mortgage of your house. We're paying for it, we're amortizing that payment over a closed amount of years. So to pay off that $61 million unfunded for this year at 16 years left, you need about $5.3 million. So again, that's the majority of the ADEC that's required. And it will be, that high for the next 15 years after this valuation. As we pay that down, we're almost on a level dollar basis. So we're going to be paying almost this dollar amount over the next few years. It's still going to be increasing slightly. But again, depending on what the experience is of the plan, will vary this. We should continue to see the employer's portion of the normal cost drop as more active members are phased out and into retirement status, and we have no new ones coming behind them. We should see the employer's normal costs start dropping. And you see, just due to the ERW, that dropped over $500,000. So any questions on the breakdown of that $6.8 million?
Do you have any expectation on what the trend in the, or anything that shows the trend in the unfunded liability?
The trend in it? No, I mean, as long as you're making your actually determined contribution, we should anticipate this 77% funded ratio over the next 16 years. If we were to project this out, it should start approaching 100%. That's what your closed amortization period does. So you're almost on a level dollar basis. So you can figure out how much, if you use a 15-year mortgage, that's what practically you're on. You're paying more principal than interest, right? So you're making progress. So $5.2 million, you may be paying down $3 million of principal each year. Or more. You're paying down.
If I understand slide 13, though, is that it doesn't seem like it's stable at 61 million, even when we pay, or are we paying off? And it just seems like we're still behind the 8 ball on this, especially with our, we're still
dropping that discount rate.
dropping the discount rate, yeah.
Yeah, I mean, you will be, so we're now down to 6,875. We've got 3 more years until we're at the 6.5. So we should be adding about another $9 million of liability to that $61 million.
Right, so go up to 70 million.
Yeah. Yeah.
Okay, so
But
that
again,
was-
if you get experience in like investments, like that could potentially be, that could wipe out some of that experience, so projections are great to see the trend lines, but we always say don't take these for what I'm worth. There's so many assumptions that go into those assumptions.
Right.
I mean, the projections that your previous actuary did a year ago are kind of useless because of the ERW. So it's good to see trend. It's good to see trend lines, and the trend is going to increase as long as you keep a closed amortization period for at least this legacy unfunded. We should see progress in the plan.
Okay, thanks.
Yeah, no problem. And then just to finish up the city's plan, and I'll open it back up for any more questions before we go to the other 3 plans, but just to look at your actually determined employer contribution over the last 5 fiscal years. So you see, we've got the big jump here for the 2022 fiscal year. And here's the breakdown between normal cost and the unfunded. So you can see the majority of this fiscal year, the 6.8 is due to the unfunded. So again, we'll build on this as well over the next 5 years, just so you can get an idea of what historically the ADEC has been. So any questions on the city's plan before we go on to the others?
Just a quick question, the years that are shown here, so 2022, that's the year that ends in June 30, 2022, correct?
That's correct. Yeah.
Okay.
Yeah. Good thought. I'll make a note to put fiscal.
Yeah, that's right. You got fiscal year. That's right. I see. I'm good. Yeah.
All right. We will move on to the police fund, and I'll turn the microphone over to Ben. And Ben, I'll drive, but just tell me when to go on to the next slide.
Sounds great, Ed. Thank you very much. All right, so turning to our attention to the police benefit fund now, we'll kind of follow a similar structure as we did for the city plan. So starting with some key findings on slide 16. The investment return for the fiscal year ending 2020 was about 4.5%. Again, on the actuarial smoothed value of assets. The unfunded liability increased from the previous valuation of about $3 million from last year, and that can be broken down to a couple components. Again, the drop in the discount rate from 7% to 6.875% contributed about $2.5 million increase in the unfunded liability. The investment experience, the market is not returning quite what we expected them to return for the year, contributed about another $2.7 million. And in this case, for the transition, we actually came in a little bit lower liability than the previous actuary. So that kind of offset some of the increases in unfunded liability to the tune of about $1.8 million. So overall, the funding ratio slightly decreased from 77.7% in the last valuation to 76.5%. And then the ADEC for fiscal year ending 2022 is calculated to be 4.8 million. That's a slight increase from the previous valuation of 4.4 million. So we'll move on to the next slide. And again, we'll just spend a few moments just describing the membership, the population that we valued. Again, this goes back to June 30th. So it's not necessarily what the population looks like now, but back at the middle of last summer. So we valued 160 active members and 207 retirees. And these numbers are, as you can see from the last 5 years, have been relatively stable. On slide 18, again, looking at payroll and annual benefits, the payroll for the active members was about $14.1 million, with annual benefits for the retirees of about $8 million. So the annual benefits are just slightly about half of what the payroll was. Next slide. So for the population, when we ran the liabilities, considering sort of what the value today would be for their future benefits that we paid out for the rest of their lives, we calculate that total accrued liability to be $167.2 million. You can see there the breakdown, how that splits out among different groups of employees. Again, the biggest group there is the retirees, about 64%. The next largest was the active members, about 27%. And then a somewhat smaller slice there for the drop participants, about 9%. And then a very tiny group, very tiny slice for the deferred vested group.
What's drop again? I forgot from last year.
Drop is the deferred retirement program.
Okay, yeah.
Great. All right, great. Next slide, please. So again, looking at the historical asset values, again, for the last 5 years, the market value of assets for the police benefit fund was about $122.7 million. The actual value of assets a little bit higher than that. Again, using the 5-year smooth technique to kind of take out some of that year-to-year volatility. So the actual value of assets is actually $127.9 million. Next slide, please. So once we have taken the liabilities and we can add to that the assets, we kind of get to the unfunded accrued liability sort of measure sort of how well the plan is performing and where it stands at as of the snapshot date of June 30, 2020. So again, the total actual accrued liability is $162.2 million. That's how much will be needed today to pay future benefits of the memberships over time. Currently, on an actual value of assets basis, $127.9 million. If you take the difference of that, you get an unfunded accrued liability of $39.3 million. That's how much we would need to have today to be fully funded going forward. So the funded ratio is 76.5%, again, just a slight drop from the previous valuation. And the unfunded increased about $3.3 million from the prior valuation. Next slide, please. Again, this is some of these numbers in kind of a graphical form. You can see the funded ratio, kind of similar to the city plan, has been somewhat kind of hovering around, just not quite at a little over 80%, but kind of in the mid 70% range. Again, has decreased just slightly last year or two. Again, some of that is due to the discount rate coming down, being phased in over time. We'll kind of probably continue to see that drift slightly down for a few more years until we start to see it go up again because of the closed amortization period. Next slide, please. So again, this is the slide for the gains and losses for you to kind of break down sort of how that unfunded liability, that increase to 3.3 million, kind of where that kind of came from. Again, because the assets didn't quite perform to the level that we expected them to, there's about $2.7 million loss. Do you see it there at the top? Go ahead and cover the change in assumptions from 7% discount rate to the 6.875% discount rate. That added about another $2.5 million to the unfunded accrued liability. And then the other big component in this chart is, again, due to the transition, we were coming in at a bit lower liability than the previous actuary. So that was a gain to the system of about $1.8, $1.9 million. And then the other components there are really kind of more our actuarial assumptions, our experience assumptions. Again, for salary increases, we had a little bit of a loss due to salary increases being a little bit higher than we expected. Service retirements had a gain there. So a few fewer retirements than maybe what we expected. But again, you kind of see what we'd like to see with the demographic assumptions is that if the assumptions are performing correctly, if there's no need to make any dramatic changes to them, you'll kind of see some gains and losses from year to year, and you'll see them kind of balance each other out. So you hopefully are pretty much close to a net zero gain and loss due to that. So a lot of the biggest things in this chart are things that are not necessarily things that you are going to necessarily expect to happen every year. And we're not going to have another transition next year. We will have a couple more years of the assumption change. Again, we're hoping that the investment return will be what we expect it to be, although we have some inkling that it might actually be a gain this upcoming year, but we'll have to wait and see. But that kind of just describes sort of where we got to the increase in unfunded liability since the previous valuation. Next slide, please. So again, to kind of walk through the development of the ADEC for the police plan, the total normal cost, and again, this is the cost of the ongoing cost of the plan, how much you need to put into the fund to cover the benefits that will be accruing for the active members in the upcoming year. So in total, you need about $2.6 million. We expect that the active members will be contributing about $1.3 million. So that leaves a net of $1.3 million that the employer will be covering as far as the normal cost. Again, there's some extra load there for administrative expenses. Then the unfunded payment is about $3.2 million. And again, when we adjust that for some interest for the coming year, we expect that the total ADEC for fiscal year ending 2022 to be $4.8 million, which is, again, slightly above what was calculated in the last valuation. And then on the next slide, just to, again, kind of show the last several years, has been kind of an increase in the total contribution, but kind of really right about the same level it was in fiscal year 2018. Again, we probably will see some increase in that ADEC in the next few years as we're continuing to decrease the discount rate. But then hopefully after that, we'll see that level off. Are there any questions on the Police Benefit Fund plan?
Nope.
Great. Just want to go back and just kind of clarify why there's a big administrative expense load increase there for the police plan. So the definition of an administrative expense is kind of the average of the last 2 years administrative expense. So we build that on top of the contributions that will go into the plan. So there was an extraordinary big increase in the admin expense for 2020. So it kind of got built in there on the average for that plan. Yeah, I think it happened for one of the other plans as well, but don't anticipate that continuing too much further. But we want to make sure we cover that as part of the contributions going forward.
I did want to ask that question because in the fire department, it was 200,000.
Mm-hmm.
And is that administrative expense absorbed by the city or does that come out of the pension fund?
It comes out of the pension fund.
So
we want to put it back in the contributions from the city. So yeah, it's taken out as part of the trust fund, but then the city will contribute it back in to cover it.
Okay, so we're talking about over $350,000. Who is the administrator that's receiving that money? Who is the entity that's getting $150,000 and $200,000?
I'll let someone from the city answer that. We don't have the breakdown of what that number is.
Okay, thank you.
Sorry. Okay. All right, going on to the Fireman's Benefit Fund. Again, same format that we saw before, and pretty much same investment return that we saw before on a smooth basis, 4.5%. For the fire plan, their unfunded increased only about $1 million from last year. 1.9 was due to the discount rate change and 2.4 was due to the investment experience. But then we had that net gain on the transition of about $1.7 million. And then you'll see some other gains in the demographic side that kept that unfunded but only increasing by $1 million. So their funded ratio didn't decrease as much as the other two plans, from only going from 82.6 to 82.2. Their ADEC is estimated to be about $3 million for this upcoming fiscal year, and that's only about a $200,000 increase from the current fiscal year that we're in. So not a big difference here for the fire plan. They have currently about 119 active members. Again, that's been hovering right around that number for the last 5 years. And their number of retirees actually has come down over that same period as well. So only 157 retirees out of this trust fund. They're currently being paid about $10.5 million, those active members in payroll. Again, that's been right around that $10-11 million mark for the last few years. And their benefits are right under $7 million. So when we add up all of those benefits now and in the future, we get about $136 million of accrued liability for all those members. Again, about 60% is due to it's for the current retirees. They too have a deferred retirement option plan. So those folks who decided to go into this deferred, stay active, but kind of freeze their benefit and build it up into a nice pool for when they eventually retire. That makes up about 13% of the liability. And then you can see the majority, the rest is in active membership. Very similar graph to what we've seen before on the assets. Actuarial smooth is the green line. We're currently up above $111 million in this trust fund on an actuarial value basis, and about $107 million in the market value of assets, which I'm sure is a lot more now as of March 10th. The unfunded accrued liability for these guys, when you take the difference of those two numbers, is just over $24 million. They're just, again, about $1 million increase from last year at 23.2 to $24.3 million. Again, here's a look at the funded ratio of this plan. So again, as Ben said, the discount rate has kind of been bringing that the funded ratio down over time. If we had just gone from, 7.5 down to 6.5, we would have, been one big drop in that black line. But if again, we're doing it gradually, you're going to see a gradual decline in that funded ratio until we can get to 2023 and be fully invested in that 6.5% discount rate going forward. For this plan, again, there you see the investment loss, and down at the bottom, the assumption loss, and right above that, the transition gain. Again, the other piece that was a big gain was the salary increases. So it looks like the firefighters didn't get a pay raise for this past fiscal year or past valuation year that was anticipated with the actuarial assumptions. So much less than what the actuarial assumption shows. And all of our assumptions are listed in the back of our reports that I'm sure you've been sent and seen. But you can see there's a big gain. That's a big number. And again, salaries sometimes we'll see big gains where there'll be no real salary increases given for a couple of years, and then there's a true up, and then there's a big salary loss in a year where they kind of make up for some of those years where folks didn't get an increase in their salary. So, but we don't want to budget like that and use our actual assumptions like that. So we kind of try to keep a relative level increase over a person's lifetime. Any questions there on that? Okay, and again, as far as the ADEC is concerned, we're looking at just over $3 million for the fiscal year ending 2022. Their normal cost has come down just a little bit for their plan, for their ongoing costs, and they too did have a large administrative expense limit built in. And then the unfunded amortization payment is just over $2 million. And then here's a look at the last 5 years of ADEC contributions. Again, as Ben had said on the police plan, we're kind of back at the same level that the contributions were being made for the 2018 fiscal year. All right, I will let Ben take us home with the food services group.
Great, thanks, Ed. So again, looking at the key findings, again, a similar investment return for this plan of about 4.7% on an actual value of assets basis. It's much smaller plan, so a lot of the numbers may be in kind of a similar direction, but are going to be a little bit smaller in magnitude. The unfunded liability actually for this plan decreased by $24,000 from last year. Again, the discount rate change increased it by $55,000. The investment experience not being quite what we expected added to it about $61,000 in unfunded accrued liability. Again, we had a little bit of an increase due to transition. We got a little bit higher liability for this group than what the previous actuary. There's only $21,000. And then again, we'll see this later in the gain loss slide, but there was a $150 decrease in the unfunded accrued liability due to demographic experience. So there's some good experience that kind of offset a lot of the increases in unfunded accrued liability for this particular valuation. So the funded ratio actually for this plan increased from 64.6% to 66.6%. And the ADEC for fiscal year ending 2022 calculated to be $260,000, which is a decrease of about $8,000 from the prior valuation. So again, this population much smaller, more actives as of June 30, 2020, and only 34 retirees. Again, the number of actives has been coming down over time. The number of retirees has remained fairly stable over this time period. For the payroll, active members was about $1.5 million, and again, there's so much fewer or fewer retirees relative to the active members. It's only $0.2 million in annual benefits for this group. So the total accrued liability for this group then, factoring in all of our assumptions, calculated to be about $4.3 million. You can see the breakdown there. This is a little bit different than the other plans. The largest slice is actually the active members, about 61%, and a much smaller slice for the retirees, and then again, a little bit more for the deferred vesteds. Again, looking at the assets, the market value of assets was $2.7 million for this plan. Again, using the 5-year smooth technique, we get an actual value of assets of about $2.9 million. So then the unfunded, then we consider when we compare the liabilities to the assets, we get an unfunded accrued liability of $1.4 million. And it's just a slight decrease from the previous valuation of just $23,000. Again, just a picture of the funding ratio. This one is kind of showing the same kind of pattern with the funding ratio. It's been kind of coming down a little bit, actually increased from this last year again, primarily due to the good demographic experience, kind of offsetting some of the other losses we saw. And so again, you can kind of see a similar graph here as far as the, the losses for the investment return, for the assumption. Not as big of a gain due to the transition. We're much closer for this plan than maybe for the other plans we transitioned. So again, the big components of that demographic gain were due to salary increases. Again, as Ed mentioned, a lot of times salary increases can be a little more volatile than the other assumptions that we measure. Things like mortality are not really going to swing too wildly from year to year under normal circumstances, but things like salary increases will tend to kind of be a little more volatile. And this is just, looks like this may have just been a year where the salary increases were not quite as much as we expected. Again, the service retirements as well was a little bit of a gain due to that, just not as many retirements as we expected in our assumptions. And going to the ADEC, we calculate the total ADEC to be about $260,000. Again, it's about $8,000 left.
Lost Ben's audio.
Yeah, all right, I'll finish up. So again, here's just to look at the last 5 years of the ADEC. Again, the drop in for the last fiscal year. And then I'll just finish up with the just quick review of the OPEB. Again, we didn't do a valuation for 2020, but just to remind you all what the 2019 valuation look like? The unfunded liability was about $50 million for the 2019, and the funded ratio was about $66.6 million. With the transition savings for this plan that we could potentially see for the 2021 valuation, we could potentially see a funded ratio above 73% for this next valuation. And again, depending on investment experience, demographic experience, and that kind of stuff. So, so there is, but every 2 years we do a calculated ADEC for a 2-year period. So the prior actuaries numbers for the fiscal year ending 2022 is about $10.2 million, which was about a $400,000 increase from this past year. So just, even though those aren't our results, just wanted to kind of remind the board that is an additional contribution needed every year. So we will end there on our prepared remarks and be happy to answer any questions.
Yeah, and I have a sort of a general question about how to think about the discount rate. So the discount rate is obviously bringing the future liabilities back to present value. It would include, it would reflect, an assumption about inflation, presumably, right?
Correct.
And what else is in there that makes it go from 2% inflation to 6 or 7%?
Yeah, no, great question. So yeah, our discount rate is we build that assumption using a building block approach, and most actuaries use that. I'm sure your prior actuary did as well. And the first component of that is inflation. So we look at what has inflation done over the past 10 years. What do we anticipate inflation doing over the next 10 to 20 years? So, everybody has their opinion on what they anticipate inflation going to. We look at, Philadelphia forecasters, they do a survey. The chief actuary of the Social Security does a survey. Everybody can, the Fed is keeping the rate around 2%. So, what we do is kind of, when we kind of help boards come up with that kind of assumption, is we look at all of those and kind of try to estimate what we believe should be a reasonable assumption going forward. Actuaries.
What are you using? What are you thinking for inflation now?
Yes, so that's where I get it. Actuaries tend to think longer term. So, this plan's going to be around for the next 30, 40 years. So we want to build a reasonable assumption going forward. The prior actuary had 2.6% in there, and the chief actuary of Social Security had 2.6% in their long-term forecast. So I believe that that's what they were following. This past year, though, the chief actuary lowered that assumption to 2.4% going forward. So I would anticipate, that the part of the development of the discount rate be using that newer assumption of at least at most 2.4%. We're trying to get all of our clients, and we do experience studies every 2 years, every 5 years for our clients. We're trying to get all of our clients down in the 2.25 to 2.5% range, excuse me. Mm-hmm. So I anticipate it being in somewhere in that range over the next 10, 20, 30 years. It could be 2%. We've seen some periods of higher inflation. We don't know what the new administration, regulations are going to do to inflation. That's all up in the air. But, if you're right around that 2.25, I would feel more comfortable.
Okay, that's one building block.
Yeah, so that's the first building block. The other building block is the real rate of return that your investments get in the markets. So each of your trust funds allocated, and you hear from your investment consultants probably much more than you hear from your actuary. So you have a better idea of the investments portfolio that each plan has, what you're investing in. And so what that looks at is, what is your investment consultant anticipate seeing in the equity markets and the fixed income markets, and what can that get above inflation? And we've seen anywhere, if you forecast that out 10, 20 years, you're looking at anywhere between a 4 to 4.5% range there.
Mhm.
So when you build that on top of your 2 to 2.25% inflation, that's where you wind up in that 6.5 to 6.75% range. And most public sector pension plans follow that format. And 10 years ago, 15 years ago, those assumptions were up in the 8.5 range, and the state of Connecticut was no different. And it's only been these past 10 years have we really seen that drive down of these assumptions in the discount rates, mostly driven by the inflation assumption, but there has also been a more conservative approach in that real rate of return assumption that you find in the market.
So I get that. What I was really confused about was, I thought that pension payouts were a function of a person's salary, their salary when they retired.
Right.
And I could see where you would assume that someone who's an active employee now, by the time they retire, their salary will go up, but it won't go up by 6%. It would go up by something closer to the rate of inflation, presumably.
Right.
So I was really looking at, what are we actually paying retirees, and why isn't that why isn't that suggested discount rate more closer to inflation?
Well, no, I mean, for the payroll assumption, you have and payroll has their inflation assumption as well. And then anything above inflation for promotions, for seniority raises, or anything above inflation. So that's that component. Now, I get your point. For a closed plan like the city and the food services plan, we want to get that assumption down towards a risk-free rate. So you can take the risk out of the markets and get down to more of an inflationary rate. But you still have a number of years before you get rid of all of your active members. So the plan and the city have time to get to a very much more conservative assumption for the discount rate for those plans. But definitely when the plan is all retirees, we should be really looking at a very risk-free rate and get out of the markets entirely, or very little, really change that portfolio structure. And your investment consultants are better experts than I am at it, but it'll drive that 6.5% assumption much further down. The plans that are open, you can take that risk in the market and invest because it's an ongoing plan. It's not like a private sector plan where it can be shut down at any time. That's not really going to happen in the public sector arena. So you have that time and you can take that risk. So that's why you see more returns, more discount rates around that 6.5 to 7%.
Yeah, no, I understand. I guess but if you're using 6 or 7%, that's implying that the salaries for the universe, for the active employee universe, is going up by 6 or 7%, correct?
No, the discount rate has nothing to do with the salaries.
But isn't the liability directly tied? It's a formulaic function of salary when you retire, correct?
Yeah, but what we're trying to predict for our salaries is the benefits in the future. So then we have a kind of a forecast or projection of all the benefits that are going to be paid to your retirees that are based on your salary at retirement. And then so you got a stream of benefit payments from 2021 all the way to 2090 for that last retiree from your plan. We're discounting those all back to today at the 6.5%. But that doesn't have to do anything to do. Your benefit is your benefit. That's based on salary, but discounting it back today doesn't have anything to do with payroll.
And that's because the benefit goes up because of years of service or what?
Yeah, you've got that piece of the component of your benefit is going up by service as well. But you're trying to, you got a trust fund of assets, and you have to pay these benefit payments over these next few years. Well, that growth and that ability to pay those benefits is tied on to how much of investment earnings you're going to get, not based on what your payroll is going to be in the future.
Well, the liability is the same regardless of our investment return.
Well, that's why we use the same discount rate to project out our assets and discount the liability, or else there'd be mismatch and your funding of contributions would be all over the place. That's why we want to mesh those together.
Could you go back to the slide that had the police salaries and payouts? So if you look at this one, yeah, right there. So their payroll is basically flatlined. And so I guess, so the liabilities, I guess what I'm stuck on is why wouldn't the liabilities kind of assume that same kind of a trend, that the payrolls, if they didn't hire any more police, that there weren't raises and other than for cost of living adjustments, I'm still confused why the pension liability would increase at anything faster than the rate of inflation, assuming their pay increases kind of are matching inflation.
Right. Well, like you said, you're getting those service, so you're getting additional service on top of that. So that's growing at whatever years of service. So if they get 25 years and they get another year of service, you're growing at 4% each year there. So that's kind of building on to that as well.
So it's inflation plus years of service. I understand that, but that's the main drivers, I guess.
Yeah, and I think it might be helpful to describe our process in a little more detail. Is that what we do for the actuaries is when we create a stream of benefits for each of the members, for the retirees, we're taking their benefit payments as they exist as a valuation date. And then for the active members, we're taking their years of service and their salary and going forward with our valuation assumptions in terms of what their salaries are going to increase to, what assumptions we have for when they're going to retire. So really, we're creating a stream of future benefits for each member from the valuation date until the day that they die. This really has nothing to do at that point with any kind of discount rate. So
yeah, I
once
understand.
Yeah,
and you're assuming presumably salaries are increasing at around the rate of inflation, I presume, or?
Well, the salary increase is part of inflation. Part of what we assume will be merit increases as well. But that stream of benefits really isn't dependent on the discount rate at that point. It's just when we decide to calculate the present value of future benefits, the value today that we would need to have in the bank to pay out those future benefits.
Yeah, I get it. Okay. Yeah, I understand. I was
That's
just
what
trying
the
to
discount
understand what factors went into increasing, over time. It's years of service, it's inflation, it's merits, it's all that stuff, which presumably adds up to around 6%.
If we used a different discount rate, we would certainly get a different liability number. So really that determination of what discount rate to use is kind of built on the idea of, well, what do we think that the money that we're funding each year will earn over time? We're trying to match that up. So if we don't think that the fund will earn 7%, then we don't want to use 7%. So we think currently the plan is to eventually get to 6.5%. That's what we think that the fund will earn over the long term on average. And so based upon that, we want to be putting in money that will grow at the 6.5%, that will match up to what the money we would need to have today to pay out those benefits, assuming that money will grow at 6.5%.
Okay. Thank you.
Any other questions from anyone? If not, I'd like to thank you, gentlemen. I wanted to know that I was on the committee to select the the actuaries, and I was very impressed with your presentation, and I'm happy that you're going to be here. Thank
Yeah,
you.
thank you, Frank. Thank you so much, everybody. Wish we were there in person with you all, but hopefully next year we'll be able to
Well, I
get a
hope
trip
so.
up to Norwalk.
All right, thank you.
Next
Thank you
year in
very much.
Jerusalem.
So the next, if there's any discussion now, or if not, we're going to move on to the asset allocation discussion. Britt?
Great. Thanks, Frank. And Ed and Ben, thank you. That was a good presentation. So last month, we discussed the asset allocation analysis that Callan conducted at length. And one of the requests was for Callan to come back with the current target asset allocation versus the proposed target asset allocation and the various ranges involved. So you can really see a side-by-side of what we are proposing. To refresh you all as I start to share my screen, we were not recommending, we were recommending really changes on the margin where the board has expressed little interest to continue to allocate to infrastructure for various reasons, all of which are certainly legitimate. And there's a 6% target to infrastructure. So if the pension plan and the board does not want to allocate to infrastructure, we wanted to deploy that capital elsewhere. So here you can see we have the asset allocation or the market values as of the end of January, which includes an $8 million redemption from domestic equity to fund future benefit payments. We have the current target asset allocation and ranges, and we have the proposed target asset allocation and ranges. I think that the easiest way to think about this is we're reducing the infrastructure target to 0 because there is a current 0% allocation to infrastructure with little desire to allocate to infrastructure. We are reducing the private equity target from 6% to 3%. The reason we're doing that is because the board has expressed the interest to maintain liquidity of the pension plan and is no longer allocating to future private equity funds. So 3% is roughly the average allocation that we expect over the next 5 years or so. And so the 9% between infrastructure and private equity, we're suggesting allocating it to mainly domestic equity and a slight increase to international equity. And the goal here is really to maintain the risk profile of the pension plan. We're not suggesting changes to global equity long short, domestic fixed income, or absolute return. You're diversifying assets. And when you look at the current asset allocation versus the proposed targets, it's really two changes that would occur on the margin. A slight reduction from the PIMCO All Asset Fund, which currently does have a target of 6%, but because of the wind down of infrastructure, that allocation has been increased to over 9% over the years to try and make up for that. And a slight rebalance from global equity long short, which is almost 2% over target. And deploying those assets mainly into domestic equity. So I'll pause there. I know, last month was a very long discussion and a lot of great questions and feedback. And we did want to bring this back with the hope that we could continue the discussion and really try to get to an asset allocation and a target asset allocation that more aligns with what the actual allocations in the pension are. So I'll pause there.
Brett, how long? What would you think would be a reasonable time frame to transition from where we are to this? Would we do this
So-
kind of gradually, month by month, quarter by quarter? What do you think?
Yeah, so the PIMCO All Asset Fund is very liquid. I would have to confirm, but reducing that exposure by about 3% and deploying it to domestic equity wouldn't take long at all. We'd want to come back with a proposed rebalancing summary about specific domestic equity managers to make sure that we're maintaining our, the right market capitalization and exposures within domestic equity. But that can happen very quickly. And then if you wanted to reduce global equity long short on the margin, that is quarterly liquidity with 60 days notice. So it would take a few quarters to rebalance out of global equity long short. But the other transaction would be very quick.
We could probably accomplish some of it by redemptions as well, our cash needs.
Yep, I agree.
Yeah, I like it. I don't know what other people think.
Looks good.
One thing, I'm not as big on downsizing the PIMCO, only that, their returns have been reasonable and they are partially in, partially in stocks. They give us just a little bit of an inflation leg of their three-legged stool. I'm not, as far as the reducing the long short, I think that's fine. The other thing is I wouldn't mind having the bands a little wider. Usually we do keep, not that, whether we went, just, I was looking more at what the stock number was, whether we're going to keep a lower limit of 63 and, an upper limit of 75. 75 would seem pretty high in stocks. But, if we're going to go to 69, I guess 75's, I guess I have concern is I feel like in some ways the stock market seems to be awfully frothy and to be, we've been more bullish on stocks and that, we've been above target for a long time. And then now to jump, basically we're going up almost 10%, as far as going from a target of 63% to 69% is just under 10%. That's pretty large jump. But.
And Frank, I think I would, with PIMCO, I think a 6% allocation to PIMCO is enough to be able to be a ballast to any inflation and really have an impact on the total plan. I don't think the intention for PIMCO was ever to be over 9% of the pension plan. And that large of an allocation to one manager is a lot for a $500 million plan. A lot of specific manager and fund risk. And with the equity increase, while it is an increase, you'll see in the January flash report that equities were up to about 68% on their own at the end of January. And while timing the market is and valuations are high, I think in terms of a long-term target asset allocation that we're thinking about over 10, 20 years, we can dollar cost average in, we can slowly do this. There are different ways to really reallocate or rebalance the portfolio. It doesn't have to, all be at once.
That was actually what I was thinking when I asked the question about the timing. I would kind of work. I'd prefer to work to these targets on a more gradual basis.
Certainly, and we can bring back a more long-term plan in terms of that rebalance. It doesn't have to all be at once or anything like that. That was just trying to express how liquid
Yeah.
PIMCO was.
Well, yeah, I mean, that's, PIMCO's liquid, but the long short funds, like BlackRock, isn't that liquid, right? Don't we have to give them 90-day notice?
Yeah, I
Just a
believe
second.
it's 60-day notice. It's quarterly liquidity with 60 days notice. So yeah, essentially, it's going to take a couple quarters to see the redemption from there.
Yeah, hey, listen, we should go. Yeah, I mean, where were you like years ago when we wanted to dump all our bonds and put it all in stocks? Now you want us to get, you know. I
Where's
mean,
Tom when you need him?
yeah. So, yeah, is there anybody who has any other discussion on this proposal? And do you want to adjust our, do we want to adjust any of these lower limits just to give us, you know,
I think, Frank, based on what you're saying, if you adjusted the lower limits on the domestic equity,
right. Well,
We're
I mean, what I'm looking
we're
at,
there. We're there. There's no need to
Right.
make any radical changes based
Right,
on the,
I guess what I'm looking at is say say we have 69% in the market, right? And the market goes down 12%. We're below the lower limit. Right?
Well, it's okay to breach a limit if the board acknowledges it, understands it, and makes the decision to temporarily stay outside of the range. I think.
Well, not only that, but the other way to think about asset allocation is if the market goes down by 12%, that should tell you it's a buying opportunity in equity, and you should bring it back up by selling bonds and buying stocks, right? That's why you have asset allocation guidelines, because when it disciplines you to buy low and sell high.
I think the only thing you've got to change is a lower limit on equities.
Yeah, I would like to see a lower limit on equities.
What do
For
you
total equities?
Yeah.
Domestic equities.
I'm sorry, I couldn't hear you there, Joe.
Domestic equities.
Domestic.
Right, if you lower the domestic, then obviously the total gets lowered also.
So maybe we lower domestic to 27 so that the total goes down to 60?
Yeah,
Yeah.
Or
That
Yeah.
seems
It works.
reasonable.
if Rich wasn't here, I'd say, can we get the bond down to a lower level of 0?
Hey, we could have negative real rates.
Yeah, we could have, but we didn't. And I'm glad we didn't.
yeah, where's the Bitcoin in here? Is that come
Yeah,
on?
yeah. Yeah,
Based on tweaking that, we're where we need to be.
right.
Yeah, I mean,
So-
the current asset allocation is very similar to the proposed. It's
Right.
really just minor reduction, minor rebalancing. It's not
Yeah.
a drastic change by any means.
Mhm.
And if we
So
talk
what
to-
about if we changed it from the domestic equity from 30 to the lower limit from 30 to 27, and therefore the total equity would go just a lower limit to 60. We don't change any targets. We don't change any upper limits. Does that sound reasonable to everyone?
Yeah.
Yep.
Works for me.
And if that's the case, I think we do need a motion to do this. It's-
Yes,
So if there's a motion to do that, then we could vote on it.
I will
So-
make a motion to accept the proposed asset allocation targets with the adjustment of the domestic equity to 27%. And everything else stays the same, obviously, the
And
total equity.
total equity lower limit
Yeah.
goes to 60.
Yeah.
Right. Is there a second?
I second it.
All in favor?
All right.
Aye.
Perfect. Passes unanimous. Okay.
Great. Thank you all. And next month, I will bring the updated IPS for us to review with the new target and ranges, as well as a rebalancing proposal for the board to consider.
And
Okay.
would you look into what we'll do with the long short? If we're going to reduce, are we going to reduce that?
Yes, we will. And
So-
I think that one is probably makes sense to submit a redemption request sooner rather than later, given
Right.
the time frame. So we'll certainly make that more of a priority.
Should we do that now? I
You
mean,
could if you'd like.
Is it
Uh,
quarterly based on calendar quarter?
Right, so if we get it done, if it's quarterly and it'd be the end of March, so we should do
Right.
it now. We're gonna be waiting till the end of June to submit.
Let's do it. You're talking about the UBS? No.
So we would suggest right now, bear with me, I'm going to pull up the pension flash report so you can all see it. So we would suggest taking about 8 million from Blackstone, which should bring it down into the 8% target range. And it'll be more evenly allocated with your complementary manager ABS.
Mhm.
Yeah,
I make a motion to redeem 8 million from Blackstone. With the
Okay,
request.
that's good. Is there a second to that?
I'll second
Second.
that.
Any discussion? If not, all in favor?
Aye.
Opposed? No. Passes unanimous.
That's
We don't
going
have
to
to-
cash for now? That's just going into cash for now or what?
Well, I believe that it's going to take us a period of time to get the
Yeah,
money.
okay, right.
So we don't have to make a decision now as to what to do with it.
That's true. Yep, okay.
Because we got to
Yeah,
find out if
and-
Silchester is still open.
We'll confirm with Blackstone tomorrow, and just forward the board the details so that everyone's aware, when the funds will actually be delivered.
Perfect.
Perfect. Chitsame, are you on?
Yes, I'm still on.
Thank you. I'm glad that you're patient. Will you need any cash?
I'll be okay through the end of April right now.
Okay. So we'll do something in April then.
Correct.
Because I did notice the cash level was a little low, I thought. Okay,
Yeah,
that's
there was
good.
8 million was redeemed from BlackRock in February. That's not in this flash report, Frank, just so you're aware.
Oh, okay. Perfect. Excellent. Okay, then, with that, then we'll go to performance review. Do you have it
Great.
up now?
I do. I'm way ahead of you, Frank, way ahead of you. I was
Yeah,
planning
go-
to review the January flash reports since we reviewed December last month. I sent everyone the full detailed reports and executive summaries, so happy to answer any questions on those. But if it's okay with the board, I'll dive into the January flash report since it's the most updated.
Yeah.
Okay with this board member.
Perfect. Total
I didn't
assets.
speak to the board.
Total assets at the end of January, about 501.5 million. You can see down slightly from the end of 2020, about $1.5 million of unrealized losses and about 1.4 million leaving. You'll see U.S. equity very high, large overweight. At the end of January, about 30.9% versus 27% target. That does not include the $8 million redemption from BlackRock. So that has come down. And then global equity long short, we've discussed, so that redemption will reduce that back to target. And there continues to be an underweight to private equity and real assets. And domestic fixed is under target by about 1.7%. In terms of returns, after the first quarter of this year in March and April, or excuse me, of last year, markets have done extremely well. You can see Columbus Circle, very strong returns, fiscal year to date up over 13% over their benchmark. LSV, we've talked at length about, and we had them in recently to review, has underperformed fiscal year to date, but year to date, they're up about 2% over their benchmark. So good to see, as we've seen value come into favor and growth out of favor year to date. LSV's deep value philosophy and investment process has outperformed, which is encouraging. In international markets, you can see Artisan has underperformed their growth benchmark fiscal year to date. This is, a growth at a reasonable price, so they will never keep up in really high octane growth markets like we've seen over the last 7 or 10 years. We would like to bring Artisan in to do a portfolio review, perhaps in April if the board is okay with that. It's been a little while since they've been in to present. Silchester, strong returns there. They continue to perform very well.
Frank, you gotta look up.
That was just for you, Rich. BlackRock Emerging Markets, again, been in the portfolio about a year and a half, having a good fiscal year in a risk-constrained strategy. You can see our global equity long-short managers, compared to public markets, really tough to keep up, but strong performance there, 13% and 13.75% for ABS. And, they continue to really be good diversifiers for the portfolio. In terms of fixed income, your managers continue to do well. You can see both outperforming the ag. UBS continues to do very well. It's been a tough index to keep up with some of the growth strategies in there, but their long-term returns have been very good. And you can see PIMCO has done very well fiscal year to date. So total return through January fiscal year to date up over 17.1%, well above the benchmark. And you can see, long-term, last 5 years up over 9.8%, and the last 7 years up almost 7.5%. Any questions on performance?
I'm good.
Well, I do have one comment to make.
Uh-oh.
Okay. No, this is for Rich, to make Rich happy.
It takes a lot more than a comment to make me happy, Frank. You ought to know that by now.
I have the results. I have the results of February for Silchester. And the MSCI was up 2.2% for the month, and Silchester was up 4.2% for the month.
Doubled.
And year to date, the index is up 1.2%, and Silchester's up 5.4%. And that's using the MSCI, the EAFE, which is
It has growth and value in it.
right. And so that's really a higher number.
I'm glad they're making up here.
So I just wanted you to know that.
Now,
why it's
value's been doing catching up.
Yep.
Yeah.
And
Still got a ways to go.
that it does.
Any other questions about the performance review?
Hopefully
Or-
it's not a gale force wind in its face anymore.
If not, then we're gonna have an executive session. So I guess if there should be no public involved. And Britt, you'll come on in a little bit, because we have an OPEB meeting tonight also. Okay,
Yep, sure, Frank.
we're gonna just be a few minutes, or you could stay on. I mean, you just, whatever.
No, I'm happy to sign off. Why don't I'll sign back on in
Uh,
5 minutes.
Why
Is
don't we
that okay?
do the OPEB first, Frank?
Well, because
Right.
we have to then postpone one, delay
Oh,
one meeting.
yeah, different
So,
meeting, okay. Yeah, never
it's a
mind,
different
okay.
meeting. Okay,
Yeah, okay.
so anyways,
I'll come back in 5 minutes.
that's perfect.
Great.
Okay. Because of the situation where there was a gentleman who wrote something, and I was grateful, by the way, that so many of you responded with emails